Anthony Doyle, Chief Investment Strategist at Pinnacle. How does someone get to that status?
Oh, Brad, blood, sweat, and tears. I've been in markets now, don't let my face fool you, 24 years. So I started in 2002 and I was at Macquarie for 5 years and I left just as the subprime crisis was starting to hit the headlines. And I moved to Dublin. First I went backpacking around Europe and then I moved to Dublin and I worked on a fixed income and currency desk there during the GFC. And so you talk about a crisis. We were worried about cash coming out of ATM machines. It was that dire. All the banks got nationalised, house prices halved, unemployment up to the high teens. And so I ended up leaving Dublin. I would have stayed, but my girlfriend at the time, who's now my wife, she couldn't get a job when the Irish were looking for roles, obviously, and she was on a tourist visa. So I moved to London and I got a job in March of '09. And that was really the bottom of the bull market that we saw up until COVID. So I was there in London for 10 years on a global macro desk where we were running hedge funds and long only funds. And there I worked across debt markets, so government bonds, investment grade corporate bonds, high yield junk bonds, EM debt, hard and local currency, and FX. So I've done a bit of everything. I'm an economist by trade, worked in bond markets for 12 years, worked in multi-asset and EM for 3 years, global equities for 3 years. Before I would say coming home to my true calling and passion, which is really macro strategy, asset allocation, constructing portfolios. And so it has been quite the journey. But that's the great thing about finance. You can really work all over the globe. Always interesting. You're always meeting really intelligent people, and it's just fascinating. Despite all the changes that we've seen over 24 years, no one can crack it. No one can continually outperform the market, or very few can. And so that human behavioral element is so important, and just understanding your own behavioral heuristics or behavioral biases has been particularly interesting, and talking a lot to clients when markets are volatile like they are at the moment, and just trying to find the signal through the noise is something that I'm really excited to do on a daily basis.
You have seen it all. There you go. 2002
Yeah,
had
I
the
know.
global
Feel
financial
like an old man,
crisis.
Brad. But yeah, so I saw subprime crisis, GFC in Dublin,
Yeah.
European debt crisis, Brexit, Trump 1.0, Trump 2.0, COVID.
Just on that, for new investors who haven't seen any of these huge dips in the market, just say we had someone invest in the last month, what should they be expecting when investing in the equity market?
Yeah, I mean, it's always great to read and to learn off investors through time, right? Ben Graham in the 1930s, he wrote, and he has a famous quote that he says, the market in the short run is a voting machine, but in the long run, it's a weighing machine. And even, almost 100 years ago, what he was describing is that what moves markets in the short run, and it's accelerated today, is really what we describe as noise. So you're talking about headlines, you're talking about geopolitical risk, you're talking about technical trades, for people set trading and buying on liquidity, sentiment, behavior. But in the long run, a share price or a stock index has a very high correlation, around 98%, to earnings. So it's very hard for a company that is continually growing earnings to underperform from a price perspective of its share price. It's very hard to short a company that continues to grow earnings. And so when I talk to investors, you articulate that an investment in equities is a long-term investment. And Charlie Munger said, those investors that can't stomach a 50% decline in their investment deserve the mediocre results they're going to get, because volatility is part of the price you pay for the higher returns that the stock market generates over the long run. But it's a journey. It's a wild journey. It's a roller coaster. I'll give you a statistic. Since 1950, the average US equity market return has been 10% per annum, which is great return. The average retail investor's return has been 4% per annum because they get shaken out of their positions. And it's difficult. If you're investing your life savings or a sum of money that you've saved, working hard, and the market's down 10% and there's a dollar sign next to that value, it's hard not to say, oh, bugger this, I'm going to sell now. But even if you think about those crises that we spoke about before, whether it was COVID, the GFC, European debt crisis, concerns around Chinese growth, Donald Trump 1.0, Donald Trump 2.0, what was going on with the invasion of Congress, tensions in the Middle East, Operation Epic Fury, the market has always rebounded. And that reflects, growing earnings because economies are expanding. And so, working in terms of in capital markets for this period of time, just refocusing people on what their long run objectives are and appropriately diversifying across equity markets.
Do you think people look short term? If you think about even some advisors are potentially trying to play this game of right now, there's a lot of volatility. They think markets are high. They're moving a bit more to cash. You mentioned holding for the temporary declines usually gets you the highest return. What would you say to those people trying to play the timing of the market?
It's tough. It's a tough game. I haven't seen many that can do it consistently because, as of March 31st this year, the market was at an extreme level of what we describe as bearishness, pessimism, worse than Lehman Brothers, March 31st. Well, I can tell you the S&P 500, where we sit today, 24th of April, is up 10%. So people were probably selling at the bottom and have missed this 10% rally in stocks. The ASX 200 is up about 5%. And so, again, when you're trying to invest in the market, you have to fundamentally assess each investment on its merits individually. If you're trying to come in and out, it's a good way to just leak excess returns, like that statistic that I mentioned earlier, that 4% return from the average retail investor. So, where we stand today, I can tell you that risks are growing, whether it's stagflation, higher interest rates, weaker growth, but maybe the US economy goes through an economic boom environment, one big beautiful bill act, productivity boom from AI, high-tech investment, capital expenditure into data centers, lower interest rates. What I can do is build investments around both scenarios, build portfolios around both scenarios that will do well under both eventualities. But more often than not, over the long run, you should be overweight equities, underweight defensive assets. And really, timing around that is so difficult to do.
No, agreed. I'm keen to touch on current market conditions. You talked about the 10% increase. With everything going on, ongoing wars, rising oil prices, interest rates increasing, what do you think the market is up at the moment?
It's a confluence of factors. One is really the market is looking through the crisis in the Middle East and is very much viewing that the taco trade is on. Trump always chickens out. And we know from Liberation Day or other types of geopolitical events that Donald Trump has been involved in, whether it was tariffs or whether it's Greenland or whether it's a tax on the US Federal Reserve, that when markets start to move against him, so bond yields start to rise, equity markets decline, presidential approval ratings fall, inflation expectations rise, gasoline prices increase, he tends to do a favorable action which markets like. And this is just short-term noise. But as I said, the market's up 10% this month in the US on the view that the Strait of Hormuz will reopen and energy prices will decline. And so you need to understand that the market is the interaction of many different investors that have very different investment time horizons and risk tolerances. And the driver of short-term market action today are hedge funds trading on leverage, quantitative style strategies like low volatility targeting strategies or momentum trend following strategies, for example. So as the market lifts, they buy more. As the market sells, they sell more. And we're also seeing increased participation in markets from retail investors trading on margin, trading on leverage. So any volatility to the downside, they get stopped out and they have to liquefy their positions. Day traders, high frequency traders. So you've got those types of investors, and then you've got the long run investors, which should be Aussie investors. It should be, that go to financial advisors. It's family endowments, it's family offices, it's institutional clients, so superannuation funds that are thinking, what does the world look like in 10, 20, 30 years? And do these valuations reflect my outlook for the next 10, 20, 30 years?
So within that, there was a few different factors, and those factors within itself create an inefficient market. Why do you think those mispricings actually happen?
Well, it's a combination of trading on leverage. Leverage kills, whether it's margin, you're getting wiped out on margin, whether you're trading derivatives like option strategies, puts and calls, for example. And so the real arbitrage, the one sort of free kick that Aussie investors have today is taking a long-term perspective and being patient. So when markets do sell off because of forced selling, because of higher risk aversion, because people are running for the hills, you fundamentally assess that investment. And if you think that the outlook is still good, well, then you should be increasing that allocation. Market sell-offs are an opportunity to allocate more to your favorite investments rather than sell. Provided the philosophy and the thesis of why you invested in the first place hasn't fundamentally changed. And this is what active investors do. Whereas the passive investor invests blindly no matter what the conditions and are following what has happened in the past. But today, where we sit at an inflection point of a transformational technology in artificial intelligence, now more than ever, you have to be forward-looking.
Yeah, I'm keen to get the definitions on the active versus passive. The term that you threw around there was more about putting into investments and then holding for the long term, not trading within that. But then there's the other part of it where you're going into a fund that's actively trading. Can you explain the difference there? And what are your opinions on those two as well?
Yeah, I mean, it's so the language that the industry uses is passive and active. Passive being you are getting exposure to a market like the ASX 200. That fund that gives you that passive exposure, by definition, will underperform the index. It has to, because they're charging you a fee. It might be 0.006%, 0.1%. We talk in basis points, but generally the reason that investors have been allocating to passive style funds that give you market exposure to 200 companies on the Australian Stock Exchange, the 200 largest companies on the Australian Stock Exchange, is because it is cheap. It might be, like I said, 10 basis points, 6 basis points, etc. And the passive industry, the investment firms that provide these funds to Australian investors, like Vanguard and BetaShares and BlackRock, for example, have been very successful in marketing these funds as cheap ways to get that exposure. And they are cheap based on the historical track record of the active fund managers, which is where I sit. Don't forget where I work, right? So we're the house of active boutique investment managers. And they all say, Vanguard, etc., will say the average active manager underperforms the benchmark, the market. So why should you pay a higher fee for underperformance? And that's a good argument. That is accurate. The average active manager does underperform, and there's academic literature that suggests that. But what they fail to acknowledge is that the top quartile or top decile of managers within a particular asset class, like Australian equities, they can generate substantially higher returns than what you'll get from the market after fees. Price is what you pay, but value is what you get. So what you might be leaving on the table is the opportunity cost of allocating to an active manager who outperforms the index by 2% per annum, 3% per annum, 4% per annum. If that's the case, if I have performance that is 7% over the benchmark per annum, I double the return in 10 years. And so when I talk to clients, the real emphasis has to be on identifying those managers that can deliver that return above the index. And the way that you do that is really by assessing their long-term track record. And what we do where I work at Pinnacle, we take minority investments in independent boutique active investment managers with a long run track record of delivering excess returns above the benchmark over a long period of time. It might be 20 years, even longer. And we assess these managers before we invest ourselves. And what we do in investing in these boutiques, and they often have the boutique edge, is they're founder led and the investment teams have equity in the business, and they're often mandated to co-invest alongside clients as well within the funds. So if the fund is underperforming and the client is having a bad experience, I can guarantee you the investment teams are having an even worse experience, which creates a very strong level of alignment because they've got skin in the game. They've got skin in the game with the end investor, which isn't necessarily true for the active industry as a whole. So we see 200 investment teams a year that are looking for an investment from us. We've invested in 19 since 2002. So it's a very high hurdle to attract an investment from Pinnacle on behalf of our shareholders. But we're very confident that the firms that we do invest in, well, I can tell you the track record, those that have a 5-year track or more of the 60 or so funds within the Pinnacle boutique affiliate range, 86% have outperformed their benchmarks. And that's a statistic that the passive index players won't necessarily tell you. But essentially when you buy a passive index, you're buying the good and the bad. The firm that might appreciate in value by 5 times, but equally, you might be buying the firm that has poor ESG policies, or might be derating because of increased competition in the sector, or might face headwinds from higher oil prices. You buy the good and the bad. And what we're trying to do is outperform that index, obviously net of fees.
What does previous track record, what does that show, previous track record?
Ideally, the longer the track record, the better. And as I said, when it comes to equity markets in particular, if you do the due diligence on an investment manager, their philosophy, their approach, the resources they have, the team that they have, the skill set that they have, and you decide to allocate, ideally, that should be with a 5 to 7 year investment time horizon. I can tell you that's how the superannuation funds invest. So if you allocate to a fund after getting the sort of ticks for all those boxes and they underperform in the next 12 months, the super funds aren't selling. They're giving the manager time to outperform and do what they have historically done. Now you want the longest track record possible, managing through different market cycles, through different geopolitical events, through different market conditions. Interest rates were up, interest rates were down. You can think about how much the world has changed even since COVID. Because that will really let you assess their track record, importantly, but their philosophy, their approach, and how they reacted in different types of environments. Which is why I mentioned earlier, if you're allocating to a fund that has a very short track record, like 6 months, it's difficult to do. So you want those teams that have worked together for a long period of time, that have established long track records. And of course, you want them to be able to deliver excess returns in different types of market conditions.
Man, the average retailer investor gets 4% return. I've never heard that. I'm curious to get your thoughts on why that is and what the biggest risk investors face to themselves.
Well, it's easy. They buy high and they sell low. And so, Brad, if we cast our minds back to recent living memory, a level of uncertainty that is similar to what we're seeing today in terms of AI was COVID. You sometimes forget that it was only 6 years ago, but we didn't know when economies were reopening. We didn't know when the borders between Victoria, New South Wales and Queensland and the rest were reopening. We didn't know if there'd be a vaccine. You can remember the hysteria around, flatten the curve and, the press conferences from state premiers, so on and so forth. In that environment, what stocks did really well? Zoom, because we were going to Zoom forever. We were never going to go back to the office. Peloton, because we all started exercising at home. We didn't want to go to gyms for fears of getting viruses. Moderna, who came up with one of the vaccines. So that was the new technology, mRNA, that they accelerated through the approval process in record time. We were going to stop eating protein. We're going to use, keep on eating plant-based meats because of the impact that protein production has on the environment, for example. All these companies, since COVID, are down between 75 and 90% because it's a hype trade. It's a meme stock. And so they could never grow their earnings into the high prices that the market was rewarding them. And it's similar to today. Where I'm seeing the most price action today is selling software, for example, because AI is going to eat the software industry. And so you're seeing the baby thrown out with the bathwater, and these stocks decline in some instances by 50, 55%. This is where you need to sort of roll up your sleeves and do a fundamental analysis as to how these companies are actually going to grow. And if they're not going to grow, if they're going to be disrupted, then you sell. But I have more clients today talking about buying gold with a 6 sigma deviation away from its long run average than I do about people talking about buying Amazon or Microsoft, which are trading on prices or valuations relative to the market not seen since the GFC. And you sometimes, again, forget 2021, Nvidia declined 66%. It's the biggest company in the world. Apple, Amazon down 95% in the tech wreck. So you get these periods of volatility, and in times of heightened level of uncertainty, typically what you see is that the retail investor trades on emotion, greed, and fear. And unfortunately, it's not a good combination for generating long-run returns.
You touched on it a bit, but if you look back to your start of investment career, you're in your 20s, you're in your 30s, what do you wish someone had told you then?
I started Macquarie when I was just a month after my 21st birthday. And I look back on this now, but invest frequently and invest early. And let the eighth wonder of the world, according to Einstein, compound interest and compound returns work in your favor. Oh, I put too much money behind the bar, traveling and all that sort of stuff. Yeah, I don't regret it, but I had an opportunity in 2005 to buy an apartment in Manly for like 300 grand. I don't know what it's worth now, but I decided to go traveling instead. That sort of stuff. You can have both, Brad. You can work hard, but definitely, I should have been. And it's easier now. Back then you had to fill out a lot more forms than you do now with online trading and the rest of it. But equally, think long and hard about where that hard-earned savings is going. The other thing I would encourage as well is not enough young Aussies know how their super is invested. So check that out right now if you are watching this or listening to this, because by default you go into a balanced option, which might be 80% equities, 20% bonds. I can't give advice, but if you're not retiring till you're 67, whatever age you are, you might want to have a good look at that allocation and talk to Brad about what is appropriate. But certainly, I would do that as well. I worked in investments. I don't think I even paid any attention to it, but that can make a huge, huge difference. Just having an extra 5 years of compounding, no matter how small that amount is. And we know every Aussie is saving for retirement because we have compulsory super.
Yeah, 100%. Check the fees as well. Fees compound the same as returns do.
Yep.
Beautiful. I'm going to do a little bit of a segment, if you don't mind. It's called Rank These Investments out of 10.
Huh. Okay.
So 1 is avoid,
Yep.
and then 10 is you see a big opportunity at the moment. So we're starting off with commodities.
Oh, I like it. Yeah, probably 6 or 7. 6, 7. That's my kids. 6 or 7, I like it. The stagflation trade. I think that we're going to see continued demand for resources as a result of the world becoming more energy intensive. So yeah, maybe no, actually maybe 7.5 there. Yeah,
Okay, 7.5. Leveraged ETFs,
0.
0. Why is that?
It's like you can use a knife, you can use it to butter bread, or you can use it to stab someone. And leverage ETFs are just punting and gambling. More often than not, you see that returns are eroded due to the volatility of the underlying ETF. I wouldn't touch it.
Private credit,
Aussie,
Aussie private credit.
9. I like it. High income, robust economy, fiscal spending still strong. I will caveat that with private credit and private assets are a broad church. The decision with who you allocate to in private credit is as important as allocating to the asset class itself. I see some funds that are like 12, 13 loans to purely residential property developers on the outskirts of Melbourne and Sydney. That's a 0. I wouldn't touch that with a 10-foot barge pole. It's a bug in search of a windscreen. Then you've got private credit managers like Metrics Credit Partners, for example, 475 staff, focused on companies with at least $750 million in revenue, senior secured in the capital structure, good diversity by sector, good diversity in terms of the underlying loans, over 300 loans, and next to no, 0 exposure in software, unlike global private credit, which has lent extensively to that space. And we know about the concerns around software with the ramping up of AI large language models and the tools that they provide. So be very careful as to who you're allocating, but done well, you're looking at 8, 9, 10% yields and of a very short duration nature. So as the RBA hikes, those yields will get better.
Beautiful. 9 if you've done your research.
Correct. 0 if you haven't.
Long short funds.
Like them. Yeah, I'd give that a 9, one of my favorite. So we've got a couple in our range. Exceptional active managers can compound returns much higher than the index. And so that's a listed active ETF. The ticker's PGA1. The PM has a PhD from Cambridge, ex-professional rugby player for Ulster as well. Sits behind me up here in Sydney. A guy called Dr. David Allen. And ran a similar strategy in London for JP Morgan for around about 15 years as well. So long short, the great thing about that is you can really isolate your very best ideas and allocate more to them. And companies you hate that you think are going to underperform, well, you can actually make money out of that underperformance as well.
The US dollar as an investment.
No. I prefer Aussie dollar today. I'll give it a 4. The reason for that is the RBA is expected to hike rates. And if we do see some resolution to what's going on in the Middle East, oil is expected to decline and the US Federal Reserve is expected to cut interest rates. So we should see the Aussie dollar rise from here because the interest rate differentials are higher or the spread is wider. And so I would favour the Aussie dollar over the US dollar today, notwithstanding the US dollar has a strong role to play in portfolios, a diversified currency basket. The reason is in periods of risk aversion, like we just saw in March, as a result of Operation Epic Fury, the US dollar actually rallied. But generally the consensus is the US dollar will weaken as interest rate cuts come through.
Index funds out of 10.
Look, I don't think it's either or. I mean, I've put together a strong debate for active today. I think that investors and what we see from the superannuation funds makes sense. In sort of that part of the world like ASX 200, maybe it makes sense to be passive there, but it never makes sense to be index in small caps where there's less coverage from the sell side, so there's less research, price discovery is a bit weaker, and so generally the ability to generate excess returns in small caps and micro caps is easier than the very top end of town, like the big 4 banks, for example. Or if you're analyzing Alphabet, there's a lot of people focused on that stock, right? And so what edge do you have there? So I think that a blend of passive and active works well, but you never want to be passive in, say, Aussie small caps, Aussie macro, Aussie micro, private markets. And then when you are active in global equities, global mid caps, global small caps, real assets, look for those high performing active managers that have delivered over time.
But we've got two more. Bitcoin out of 10.
Oh, 0. Yeah. I mean, I sort of put that in the fine art and wine and car collectibles. If you enjoy it, investing should be fun as well. If you want to, speculate, it's not an investment because there's no income as such. But if you want to speculate on the greater fool theory, that is that there'll be someone that will buy Bitcoin off you at a higher price for no reason, then go for it. But don't make it live or die type of thing. Maybe it's 2%, maybe it's 3% of your net worth. Personally, no, it's too volatile for me. Notwithstanding, if you invested early days, that narrative took off, right, of an alternative currency to fiat currency. So never say never, but I wouldn't touch it. 0.
0. Do you think advisors should fully ignore it?
Yep.
Fully ignore it as an asset class?
Just a punt. You probably have more fun going to Melbourne Cup or casino, no? I don't know.
That does sound fun. Last one is active ETFs and active managed funds.
Well, I'm a 10 out of 10, Brad, as you know, as you've probably gained through this conversation. But the great thing about active ETFs is it's democratized the investment talent that was once reserved for high net worth investors and institutional investors, and it's democratized a greater suite of asset classes. And additionally, with the active ETF side, you own it next to your direct shares within your trading or brokerage account. No minimum investment. Fantastic innovation. But again, you have to do your fund manager selection. You do your due diligence. There's a wealth of information out there, even more accessible now with AI. We are doing webinars, we have fact sheets, we have quarterly reports. We're doing a lot of work in the media as well. So should you find an active manager within the universe or the asset class that you're looking to allocate to, it's worth going that extra step for identifying a good active manager as opposed to just passively investing blindly. Because the real key to generating long-term returns is having fantastic, what we describe as downside capture. If the market's down 10 and you're down 6, when the market inevitably recovers, and it will recover, you're starting from a higher starting point. And so again, it's just mathematics 101 really. But active ETFs and active fund managers are a worthy spot in a diversified portfolio that will do the work for you in meeting your long-term investment and savings goals.
Anthony, thank you for coming on. If people want to find more about you or Pinnacle, where should they go?
We've got a LinkedIn account. I've got a LinkedIn account. So we're very happy to connect on there, pinnacleinvestment.com, or reach out to your friendly advisor because most will know Pinnacle as well and use one of our independent boutiques on behalf of their clients. But yeah, please feel free to reach out anytime. We're always very happy to have a chat.
Love it, man. Thanks for the conversation.
Cheers, Brad.